Everyone. In Chapter 7, we have quite a bit of information, all dealing with receivables and cash. So I picked a few problems to review with you, but please make sure you go through all the practice and ask all questions you may have. Swarthmore Clothing, this is problem 7.1. I should have said that, huh? This is on page 390 of your book, and it's listed as a practice problem for you to try on your own, and you really should do that before you listen to this. Swarthmore Clothing Corporation grants its customers 30 days credit. The company uses the allowance method for its uncollectible accounts receivable. During the year, a monthly bad debt accrual is made by multiplying 3% times the amount of credit sales for the month. At the fiscal year end of December 31st, an aging of accounts receivable is prepared, and the allowance is adjusted and the allowance for uncollectible accounts is adjusted accordingly. At the end of 2020, accounts receivable were at $574,000 debit balance, and the allowance account had a credit balance of $54,000. Now, if you're trying to picture that, don't draw a T account or two. And of course, I'm going to grab my piece of paper and practice what I preach here, right? So we want to draw a T account for accounts receivable, and it says accounts receivable has a balance of $574,000, and that would be on the debit side. And then the contra account, allowance for uncollectible accounts, remember that is our contra to accounts receivable, has a credit balance in it of $54,000. Here's the activity for the year. During the year, accounts receivables increased $2,620,000, and they decreased $2,483 because of payments. And they also decreased because of actual write-offs of $68,000. Now, keeping that in mind, if we credit accounts receivable, okay, at the end of or during the year in 2021, then we must have had write-offs. Oh, there they are, write-offs. So that means we debited accounts allowance for uncollectible accounts as well, because that's the other side of our journal entry. Remember, under the allowance method, as accounts become bad, Okay, sorry about that. I needed to, if I disrupted you. We need to debit the allowance account for actual write-offs and credit accounts receivable. Now, what else happened in the aging account? Well, throughout the year, every month, the company makes an accrual. And the accruals are 3% of the credit sales for the month. So they said at the end of the year, just make one big journal entry. So they would have divided this journal entry up into monthly amounts based on the sales for that month. But let's take the sales for the year, $2,620,000. You see where that's at? That's the total amount of credit sales times 3%. So throughout the year 2021, bad debt expense is debited. The allowance account is credited for $78,600. So I'm going to post that $78,600 credit into the allowance for uncollectible accounts. And companies do this. They just want a quick bad debt expense estimate at the end of each month. Just take the credit sales for the month times their applicable percentage. So what do we have going on at the end of the year? Well, my accounts receivable, remember I have a T account. Get out of there. Sorry. Starts with a balance of $574,000. It was debited during the year for the credit sales of $2,620,000. It would have been credited for the cash collected on them, $2,483,000, and then it was credited for the write-offs. So the balance is $643,000 on the debit side. Let's find the balance of the allowance for uncollectible accounts. They told us it starts with a credit balance of $54,000. Remember, it's a contra, so it has to start with a credit balance if it's a contra asset. We increased it $78,600 during the year for estimates. Then it was decreased $68,000 because of write-offs. Remember, write-offs, you debit, allowance, estimate, you basically credit it. So going into the end of the year, the balance in the allowance for uncollectible accounts is a credit of $64,600. So we need to know that balance. So that was one way of estimating and how it affects the accounts. Now, at the end of the year, we have to make, oh, okay, there's our write-off. Remember I said you have to debit it for that? Okay. At the end of the year, we use the aging of accounts receivable report. Remember, that is just our accounts receivable balance, $643,000, where the balance is broken down by how old it is. So this report isn't just in summary form like this. This is we only use the very last line of that report to do our estimate, because the report itself would list each customer with the amounts they owe and how old they are in different columns. For instance, anyone whose sales occurred in the past 60 days and they have not paid their bill, their balance would be in the 60 days, 0 to 60 day column. So the total amount of those accounts receivables are $430,000. Anyone whose sale has occurred 61 to 90 days ago and they have not paid their bill yet, that balance will appear in the 61 to 90 day column. So the total amount of those items are $98,000. The total balance of accounts receivables that is 91 to 120 days old, so it's been almost 4 months since the sale, 3 to 4 months, $60,000. And then those over 120 days old totaled up $55,000. So we've broken that $643,000 down by its age. So then we apply percentages that the company decides on. So based on their past history, they're going to say, how much of that 0 to 60 day group don't we usually collect? And they determined it was 4%. So they'll multiply 4% times 430,000. That's the estimate of that age group. How much is the estimate of the next? Well, it's about 15% of that balance. Multiply the 98 by 15 to get 14,700. Do the same thing with the 91 to 120 days. So you would be given those percents of uncollectibles. And then finally, you would do that with the over 120 days and get the results for each age group. Well, that's the estimate of the bad debts for each age group. Now let's add them all up. So of the $643,000 in accounts receivable, the company estimates $68,900 will not be collected. What this estimate is giving us is what the new balance needs to be in the allowance for uncollectibles. It currently has a credit balance of $64,600. We needed to have a credit balance of $68,900. So the journal entry we need to create needs to get it from its current balance to what we just estimated. So debit bad debt expense, credit the allowance for uncollectible accounts, $4,300 to get it to that balance. When we use sales to do our estimating, we just go credit sales times percentage, plop it into the journal entry, whatever the result is. But when you use accounts receivables to estimate for uncollectible accounts, you're really determining what the new balance needs to be in the allowance for uncollectible accounts, and then creating a journal entry to get it there. So that's the major difference between the two, because you're using different things to estimate. One you're using sales, the other you're using accounts receivable. In requirement 3, it says, what is the total bad debt expense for 2021? Okay, well, monthly accruals totaled $78,600. Remember up here? Bad debt expense, $78,600. The very end of the year, we added another $4,300. So the total amount of bad debt expense for the year is $82,900. Going back to how we presented information on the balance sheet, when it comes to accounts receivables, we list it net, so after subtracting the allowance for uncollectible accounts. So although the balance is 643,000, whoops, sorry, I'm going all over, 643, we subtract the 68,900 and report the net, and we write it just like that. So that's how this accounts receivables would be presented on the company's balance sheet. Okay, so that was a great problem to review the allowance method for estimating bad debts. Okay, we're going to shift gears and we're going to go to problem 7-8 now, which is on page 392, which is about selling our accounts receivables. Sorry, I'm getting there. All right. Ooh, well, that's a very short and quick problem, right? Samson Wholesale Beverage Company regularly factors or sells its accounts receivables with the Milpitas Finance Company. I think I pronounced it right. On April 30th, 2021, the company transferred $800,000 of accounts receivables to Milpitas. The transfer was made without recourse. Now remember what that means. It means Milpitas cannot come back at Samson if an accounts receivable becomes a bad account. The Milpitas is the one who bears the loss. Milpitas remits 90% of the factored amount. So it takes 90% of the 800,000, 720, and retains the other 10%. When Milpitas collects the receivables, it remits to Samson the retained amount less a 4% fee of the total factored. So the total factor was 4% times 800,000. So that's their fee, or 32,000. What's the other 28,000 there that you see receivable from factor? Because this is Samson's journal entry. As we discussed in the chapter, throughout, once a company, Samson, sells their receivables, they don't have an asset called accounts receivables on their book anymore. When a customer returns something that was sold on account, Samson doesn't go, well, we just don't have your accounts receivable anymore. You better return that item to Milpitas. No. They're going to take the return, so they'll debit sales returns and allowances. Well, they don't have accounts receivables to decrease anymore. They can't credit the customer's account. They don't own it anymore. Instead, they'll credit this receivable from factor. So what this means is the factor says, we think about 28,000 of your goods might be returned. So we're not going to give you that. And if anything is returned, just decrease that amount. Set it up as a receivable. If you get no returns on these accounts receivables, we'll pay you that 28,000 once we collect them all. But we know you're probably going to have returns, and we're not going to get that money. So to account for those, keep decreasing the receivable from factor anytime a customer returns stuff. And the balance is what you're going to receive from us. That's what Milpitas is saying to Samson. The difference, the plug here, 52,000, is the loss to Samson. So they'll debit loss on sale of receivables. Included in that loss is that fee of 32,000, right? So the, oh, wait a second there, what's that, 60,000? Samson estimated, oh, the fair value of the last 10% of its receivables to be 60,000. Okay, so that's what that represents is, I apologize for that. When they transfer, when you're determining this receivable from factor, it would be the fair value of that 10% minus the fee. That's how you figure out the receivable from factor. And then the difference is loss on sale of receivables. Okay, so that's how we account for a sale. Remember, there could also be a collateral situation. And when there's a collateral, Samson in this case would not sell their accounts receivable. They're just using them as collateral. Okay, on your assignment sheet, it says to do 729, exercise 729. I think I messed up on that. So instead we're going to do exercise 734, which is a bank reconciliation, which is very, very important as an accountant to know how to do. So it's on page 388. Harrison Company maintains a checking account at the First National City Bank. The bank provides a bank statement along with canceled checks on the last day of each month. The July 2021 bank statement included the following information. Now you might want to grab a pencil and a little notebook to do your T account here. The company's general ledger balance at the end of July, the cash, so is $38,918. I don't think you need a T account. Sorry about that. Just want to jot these numbers down because when they're in paragraph form, it's harder to read. So we want to put ending balance, $38,918. Deposits outstanding, so that means deposits that the company made that were not on the bank statement. I also often call them deposits in transit. So they're not on the bank statement, are $6,300. And checks written by the company that were not cashed, so outstanding checks we call those, so they were not cashed by the bank yet. So we have deposits that are not processed by the bank, and we have checks that were not processed by the bank. So they were not on the bank statement. We're $84.20. In addition, the company accidentally recorded goodness, 2 mistakes. The company incorrectly recorded an accounts receivable deposit, which should have been $2,000, as $200. And then the bank incorrectly recorded by the company, the check correctly recorded by the company. Okay. The bank incorrectly processed a check for $30 for $300. So the bank made an error and the company made an error. Lots of stuff going on here. So the hardest part of this, and I remember learning it, and I still remember, I can tell you a quick story. When I was sitting for the CPA exam, I never could keep all this straight. And I remember thinking, please don't let there be a bank reconciliation question. The second multiple choice, I almost died. I was like, really? I passed that time, but so I know your pain with some of this stuff. I remember it. I remember the pain. So let's go up to my answer key here. Let's see how we jive this all out. So a bank reconciliation. And sometimes you got to stop and think, what is the purpose of a bank reconciliation? Well, we have, sorry about this. Let me get up there first. Can't do 2 things at once. There we go. The purpose of a bank statement is to, or bank reconciliation, is to make sure the bank's balance that they've been keeping track of our checking account and our balance, because we've been keeping track of the same thing, jive together. They equal. And a lot of times they don't equal because the bank may be missing stuff that we were aware of, or we may be missing stuff that the bank was aware of. So the bank reconciliation process is finding these missing items from both areas and adding or subtracting them to those balances. So we're starting here with the balance from the bank statement, and we always start with the ending balance from the month. So at the end of July, there was $38,018 in the bank. They go on to tell us there's deposits in transit. So whenever you see that, or deposits outstanding, these are deposits that are recorded on the company's checkbook but are not on the bank statement. Well, then we add them because they're missing from the bank statement. We deduct checks that have not been cashed by the bank. So they are on our checkbook as a deduction, but they're missing from the bank statement. And then we correct any banking errors. Now, the bank subtracted $300 instead of $30. So we got to add back the $270 difference. So once we add and subtract those items, you could see, oh, if the bank did know everything, if there wasn't anything missing, that bank statement balance would have been $36,168. Now we go to the books. We go, okay, as far as we know, our balance on our checkbook is $38,918. Now, is there anything missing? Oh, wait, we recorded something wrong. Instead of recording something at 2,000, we accidentally recorded it at 200. So we're missing 1,800 from our checkbook. Add it in. Things like the service charge you see on the bank statement. They're normally not deducted, and the assumption is they aren't. The NSF check, that's not normally there either. Remember, an NSF check is when the customer's check bounces. Bank will deduct it out of the checkbook or the bank statement balance, but sometimes we don't find out about it until we actually get the bank statement. And then there's another monthly payment on the note. Oh, we pay a monthly note directly to the bank, or it's deducted directly by the bank from this account. Oh, we must have forgot to record it in our checkbook. And that's the assumption there. So we got to subtract those things and add the error. If we had everything recorded in our checkbook properly, the balance in the checkbook would have been $36,168. So the correct balance of the cash account is $36,168. Now in our normal personal life, that's where we stop and we go, woohoo, we bounced our checkbook. Let's go do something else, right? Well, not for a company, because companies have to make journal entries. That's the only way we can update our cash account in our general ledger. So we want to record journal entries to get the items that were missing or incorrect in our checkbook recorded. And here they are. That cash where remember we only debited cash 200 and credited accounts receivable 200, it should have been 2,000. So we're going to debit cash for the additional 1,800 and credit accounts receivable. The service charge on the bank, you could debit miscellaneous service charge or miscellaneous expense. You could debit accounts receivable for the 1,200 NSF check. That customer still owes us the money, put it back in accounts receivable. On that payment of the note, 320 of it was interest, so we'll debit interest expense. The other 3,000 we will debit notes payable. And then credit cash. So when you add that 1,800 to the cash account and subtract the 4,550 to the cash account, which had a balance of 38,918. Am I right? Yep. The new balance in the cash account will be 36,168. And this process should be done at the end of each month. Okay, so just a review of that. So that's it for our discussion on the problems, the review problems, practice, whatever you want to call them, for Chapter 7. If you have any specific questions, please make sure you post them to the discussion board. I know there's some things that we didn't go over verbally, so in practice problems. So please put all and any questions out there. Thanks.